Farmers are working to navigate current economic conditions in agriculture. And while 2022 will likely be a good income year for many, 2023 might be quite different. One tool for smoothing out fluctuations from year to year is income averaging. Roger McEowen with the Washburn School of Law joins us now with further insight. Roger, good to have you with us. What are some of the basics of averaging and who all is eligible?
Well, good to be with you, Tammy. It is a tax management tool that farmers and ranchers can elect after the end of the tax year to spread out a certain amount of income from the year over the prior 3-year period. And it can be used to prevent a farmer or rancher from being pulled into a higher tax bracket in a high income year, such as 2022 is likely to be for many farmers and ranchers across the country, compared to what we think 2023 will be like.
Now, are gains eligible?
Well, it depends. And gains from the sale or other disposition of property other than land that's regularly used by the taxpayer in a farming business for a substantial period, those gains are eligible for averaging. So clearly, gains from the sale or exchange of land don't qualify. But the IRS position is that if you have gains from assets that are considered to be part of the land, so you sell off a building, you sell off fences, tile lines, for example, those would be eligible for averaging. So it's a little weird on the rule, but that's the way the IRS slices the pie.
So what are the main planning points producers need to keep in mind when using farm income averaging?
Well, it's a real good tool for electing it on ordinary income, bringing your ordinary income level down, and then having the effective rate on your non-farm capital gains be reduced. And that could be a big deal for a farmer, for example, that sells breeding stock or other assets that trigger capital gain. And although the election doesn't impact self-employment tax per se, it can still generate big self-employment tax savings if it pulls down the income beneath the Social Security base.
Now, are there any limitations?
There are. You have to be an individual. You have to be an individual that's engaged in the farming business for the year in which you make the election. And for a landlord, that means you can't be a cash rent landlord because IRS says that's not a farming business. That's a rental activity. You can't be an estate. You can't be a trust. C corporations are not individuals. For partnerships, individual partners or members can be eligible. If you're a subchapter S corporation that's engaged in farming, the S corporation itself is not eligible to make the election, but an S corporation individual shareholder is. So we have to keep those limitations in mind.
You do. A lot to consider there. So what's the biggest takeaway here?
Well, I think the big takeaway is that this is a tool that farmers and ranchers are going to want to look at come year end before they file the 2022 return in early 23 to see if 22 was a good enough year where it makes sense to drop some of that income out of 22 and spread it back over prior years that may not have been as good on the bottom line as 22. The idea is to level out that income over that basically a 4-year period, and over that period of time save taxes by getting into a lower tax bracket overall.
All right, as always, good advice. That's Roger McEowen with the Washburn School of Law. Thank you so much for visiting with us today.